Well, the Fed will raise rates by 25 basis points. I think the statement will be interesting. I think the Fed will say that Ukraine has increased uncertainty and also increased inflation pressures. But to paraphrase Chairman Powell from 2 weeks ago, they don't want the Fed to add uncertainty to what is already an extraordinarily challenging and uncertain moment. And I think the Fed is going to be guided towards moderation because they just don't want to add to uncertainty here.
So, Mona, let me jump in and ask you a question. We were talking just a few moments ago about how many rate hikes to anticipate for this year and how the changing nature of the climate geopolitically and around the globe may affect the number of interest rate hikes we get this year. Your thoughts?
Yeah, absolutely. Look, I think all eyes will also be on the new set of economic projections, the new dot plot, quote unquote. Keep in mind that at the December meeting, they had a 0.9 projected for 2022, so about 3 rate hikes. We do think that'll move up, probably 5 rate hikes at least this year. I think at that point, the Fed has some room to take a pause, look around, see what the impacts to inflation and growth are before deciding the pace going forward. We think all in, we're still looking at 2.25% to 2.5% terminal rate. It'll be interesting to see if their projections reflect that as well. And we're also going to see what they do with their inflation outlook and growth outlook for the year. We suspect growth moves downward and inflation moves higher as well.
2-minute warning, John Bellows. Where's your mind focused?
So I think today's pretty straightforward. I think the risks are they're hawkish today. Inflation's high and job growth has been good. But I want to pick up on something Mona said. I think it gets much harder from here. I think the downward revision to growth is a sign of things to come. The growth risks are to the downside. I think the uncertainty in Ukraine probably adds to those. And so while it's pretty straightforward to hike rates today when job growth is okay and inflation's high, it's going to get a lot trickier when growth risks start to emerge on the downside. And so I think straightforward today, but harder in coming meetings, and harder in particular because the growth is likely to decelerate. Risks are that it decelerates more as we move into the end of the year.
But curiously enough, David Kelly, the argument Larry Summers was making in the Washington Post last night is that he's sort of blaming the Fed for that slowdown. We all say, the macro slowdown happened to the Fed. And he's saying, no, it's because they're letting policy run too hot that we're going to risk recession and stagflation.
No, I don't really agree with that. I think that the other side of Washington has kind of set this up by putting massive stimulus into the economy during the pandemic. Both to protect people who are affected by the pandemic, but also to protect people who weren't being affected by the pandemic. That gave you excess demand meeting insufficient supply. That's why we got all this inflation here, and that's why we're coming in too hot towards full employment. But the Federal Reserve can't fix all of this. I think the Federal Reserve needs to be steady here. I agree with John that there is a danger that the economy is going to slow in 2023, and what the Fed doesn't want to do is overdo it and have to change course.
Shepard Smith here. Thanks for watching CNBC on YouTube.